Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, my guest is Micah Fraim. Micah is a certified public accountant and specializes in the taxation of cryptocurrencies, NFTs, or non-fungible tokens in small businesses. There are not a whole lot of accountants around the country who specialize in this kind of taxation. And it was great to have a discussion with Micah about where we are in terms of taxation for the cryptocurrency ecosystem in general, because as it turns out, there's just not a whole lot of guidance from the IRS. Micah is on the bleeding edge of this stuff, and it was really wonderful to hear his perspective and what cryptocurrencies investors and business owners need to think about in terms of taxation of all of this stuff, particularly if you're considering accepting cryptocurrency as payment for your business. I hope you enjoy the conversation as much as I did. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Hello, Micah. Welcome to the podcast. Thank you for taking a little time and joining me.
Oh, thanks for having me. I'm looking forward to it.
So these days, cryptocurrency is front and center for a lot of people out there. There are also a lot of people out there who hear a lot about it and know nothing about it. Mm-hmm. And there are also a lot of people that either directly or indirectly have to deal with the taxation of these things. And I'm thrilled to talk to you because you know all this stuff like the back of your hand, and I'm looking forward to soaking up a little bit of your wisdom today. So why don't you introduce yourself and tell us about your tax practice?
So my name's Micah Fraim. Our firm is Fraim, Colley and Company, and then we also operate as the Crypto Tax CPA. So I've been in practice about a decade now, and for most of that time, we've been working with online businesses or other really growth-centric businesses that have a lot of ongoing changes. And like a lot of people, I bought a tiny bit of crypto in 2017 during the ICO craze. The $3,000 I put in turned into $1,000 real quickly. And then I kind of just forgot about it until 2020. I started looking into it more, and that $3,000 had doubled, or it had actually recovered based on the losses. And then found a project I really loved, got excited about, and got more and more involved in crypto, and then pretty quickly realized that there's no guidance out there on the tax side whatsoever. So that's what we've spent the majority of the past couple years doing, is doing research on crypto taxes and a lot of crypto taxes for our clients. Kind of got there sort of by accident. We really just initially started out just so we could answer questions for our existing clients. Since they're online businesses, they're very tech-centric anyway. And then for ourselves, and then quickly realized there's pretty significant demand and not a lot of supply of CPAs who are out there doing this.
Yep, I have experienced that myself. It's hard to find people who are up to speed on all this, and given the minimal level of guidance from the IRS, as I understand it, it's just a lot of stuff to sift through. So can you give us a 30,000-foot view of where we're at in terms of taxation of cryptocurrencies and NFTs right now?
Well, the problem we're running into now is this almost complete lack of guidance that's out there from the IRS on a lot of topics. Like they've issued it on some things. They've clarified that coin-for-coin trades are taxable. You don't need to do foreign bank account reporting yet for your crypto wallets. They've said you can't do 1031 exchanges. That mining income is business income. They've said that airdrops and hard forks, if you receive a new token, that's taxable income. But that's about it. Those are the main things they've covered. So when it comes to staking income, nodes, when it comes to NFTs, play to earn gaming, all of these things that have been around for a couple years now and are becoming more and more ubiquitous, it's radio silence on those topics, which makes it really hard for everybody involved. It's hard for the tax practitioners. It's a nightmare for people who are just crypto investors and don't know what they're doing. So what we're having to do is find something that's reasonably analogous, either in traditional investing and business and other IRS opinions, and trying to apply that to the most similar thing that exists within crypto to try to figure out how to treat it. But it's bad right now. There's no real other way to put it. The state of regulation is really bad because there's so little guidance out there, and people are making, not this year, but most years are making pretty significant money doing this, and they're just completely on their own to try and figure out how to treat it.
Yeah. Now you threw out a bunch of technical crypto-related terms.
Yeah.
I would guess that most of our listeners are unaware of. And so before we skip over and get into the technicalities, IRS, we had a bill passed that funds the IRS and gives them the ability to go out and hire 87,000 people, right? Does that influx of new employees give them more ability to issue guidance, or is this just an intentional level of ambiguity from policy setters?
It will depend on how they use how the funds are actually used, because I haven't looked into the particulars of if there's any limitations on what the new employees can be used for, if they'll allow them to be used for enforcement activities. Because in the past, the IRS funding over the years has just been getting slashed and slashed and slashed and slashed. And when they would add a little bit of money back, they would say, well, this has to be used for customer service, not for enforcement activities. I don't think that's the case with this bill, but it'll depend on if there's any sort of earmarks that say, well, you have to use it for this, or if the IRS can use it for whatever they want. The other thing will be, if they do just have free reign, it's going to be the IRS's decision where they want to deploy that capital, because the IRS, so far at least, has been a little gun shy to issue guidance on things. They're mostly waiting for Congress to issue legislation, because in the vast majority of cases, if it's something there's ambiguity to it, the IRS would much rather just enforce the laws that Congress has passed versus coming up with their own guidance, having someone challenge that in court, possibly losing. We're seeing that right now with that. There's a case in Tennessee where a couple it's called Jarrett versus USA. This couple had staking income, and they sued the IRS saying that staking income should not be taxable until they actually dispose of the tokens. And the IRS offered them a settlement offer, completely non-precedent setting, but the IRS is trying to get that case to go away as much as they can, because they don't want to be stuck in court. They don't want to have to come up with their own interpretation and then be stuck in court defending it. They'd be much happier if they can just point to a law that says, hey, this is what Congress passed. So that's kind of a long-winded way of saying it'll depend a little bit on where the IRS feels that capital is the best deployed. Are they just going to send it all to people to audit, or are they going to do some of it for policy setting?
Right. So it sounds like they're just kind of off on an island at this point without any guidance from Congress at all yet, and they're reluctant to put a flag in the ground, because that's just an opportunity for countless court cases and endless litigation, right?
Oh, absolutely. And it's going to be, the whole thing it's a nightmare for everyone, but it's really a nightmare for the IRS, because they're doing their best on this, but crypto is such an emergent market, and there's so much that it's hard to tie to existing precedent. So they're in a really tough spot, since they are underfunded already, and there's not, for most things in tax law, there's 50 to 100 years worth of precedent that you can point to. Most things are fairly well established. With this being this brand new technology, it's really difficult, because one, like I'm saying, it's brand new, but two, this is going to be the case. What whether the IRS does it or Congress does it, but if they make these regulations and come out with rules trying to rein in crypto more, which they're absolutely doing and probably should do in a lot of cases, if they make the enforcement too wide, it's not really going to be enforceable. If they make the regulations too broad, it's going to be hard to actually enforce the rules. But if they make it too narrow, all people are going to do with their projects is just slightly tweak them to try and bypass the regulations that are being instituted.
Mm-hmm.
So nobody likes the IRS, and I understand it, but they're in a difficult spot with crypto, especially.
Yeah. I totally understand it. So let's go over a couple just real basics of taxation for these things.
Yeah.
I think most of our listeners are probably dabblers in this field, if at all. So if you go open an account and establish a wallet at Coinbase or any of these operate Kraken or any of these exchanges, you buy any cryptocurrency and it goes up in value and you sell it, you have a capital gain on your hands. Is that right?
Yeah, absolutely.
One interesting nuance that I've come to understand is if you take those steps, you put $10,000 into some coin and it loses value. Usually when we do this with investments, you have this thing called the wash sale rule, where if you buy a share of Apple or shares of Apple with $10,000 and the value goes down to $8,000, if you sell it, you have a $2,000 capital loss on your hands, which is kind of helpful for tax purposes, right? But you can't buy the shares of Apple back for 30 days.
Yep.
You have to be out of the position for 30 days before you can claim that loss. This is not the case with cryptocurrency, as I understand it, right?
Yeah, at the moment, yes. The past couple, it will pipe up every 6 months or so. Some member of Congress will propose that loophole be closed, but so far it hasn't been closed yet. So that's one of the really nice things with tax planning you can do with crypto. If you hold it and you're holding it at a loss, which most people who got involved in crypto last year, which was when interest really spiked up again, most people probably do have losing positions right now. So if you have a substantial loss, then it's a really good strategy just to sell the crypto and immediately repurchase it, because there's not that wash sale rule limitation. The only real limitation of that strategy is just there's going to be either gas fees if you're on a decentralized exchange, or there's going to be exchange fees if you're on a Coinbase or Kraken or something like that. So if you've got a position that's you've lost $100 on, well, the gas fees are going to eat up any tax benefit that you'd have there. So it needs to be it's sort of just scale is what comes into play. But if you have a losing position of any consequence, then it usually makes sense to go ahead and sell it and then just buy it back if you're so inclined.
Yeah. And the way we think of this is when we're managing taxable portfolios for people is any opportunity to harvest a tax loss without altering the portfolio, we really want to consider strongly, because putting these tax losses or harvesting them, even if you can't use them this year to offset other capital gains, you just kind of stick them in the bank for future use. And the more that you can do that, the better off you are, which is why we have the wash sale rule in the first place. Is the IRS doesn't want you to be able to harvest these things without altering your portfolio at all. And there are a couple, ways we can get around that a little bit. But with the crypto, you don't have to do that. Sell it, buy it right back. You're not altering the portfolio. You're not out of the market. It's a great move.
Well, and we wrote a blog article about this recently of some bear market specific opportunities that are out there. And that tax loss harvesting was the first one we talked about, because aside from those gas fees, there's really no downside to it. Well, it does reset your holding period as well. So there is something to where if you were to have a capital gain, you have to take that in consideration. But especially with how much crypto has gone down, this was the example we used in the blog is more than most people would be spending. I was like, let's say you bought 10 Bitcoins when they were 60 grand, and now they're 25,000, somewhere around there. Well, you've got a $350,000 loss on that portfolio. And for most stocks, there's risk with that, because you could lose if the market turns around, you lose all the upside. With crypto, that's even if you don't have other gains, just like you said, keep it, banking it, just having it there. They don't expire. When you do inevitably have gains in the future, be it in crypto or stocks, they're just there waiting to be used. So that's one of the main things now that most people are underwater on their more recent purchases. Before the end of the year, that's one of the main things that we're getting people to do. Eventually, it's going to be closed. And sometimes we do warn people that the IRS has been known to change things retroactive to the beginning of the year. So there's always a chance, even for 2022, that they'll say, hey, actually, retroactive to January 2022, crypto sales are subject to wash sale rules. But at least right now, it doesn't exist. And it's a pretty great opportunity.
And even if that happens and you don't get to bank the loss, all you're out are the transaction costs, right? The downside is very low.
Very low, exactly.
So what are some of the other opportunities you see from a tax perspective in a crypto bear market?
The other thing that we talked about, and you don't always have control of this, but it's a little counterintuitive, but it's actually accelerating your income. Because in most instances, we're doing with tax loss harvesting. We're trying to get your income down as much as we can, either by realizing those losses, deferring your income to a future year, doing whatever you can to push it into a future year. But when you're in a bear market, you're already not having a bunch of other crypto income. Your other sources of income are likely to be lower. So in all likelihood, you're in a lower tax bracket and paying a lower tax rate than you will when things do turn around. So you don't always have a choice. Like a lot of the things in crypto, for most tax things, are taxable upon receipt. So if you receive a staking reward, if you receive interest on, you deposited your money on an exchange somewhere and they're giving you interest on those deposits. If you're mining, most things in crypto, it's just whenever you receive it, that's when it's taxable. But there are some exceptions to that. You've obviously got control of when you're doing your trading. And another thing, and it's sort of these niche examples, but there are certain projects where some node projects can be a good example of this, where the IRS says that your income is taxable upon receipt and when you have what they call dominion and control over the asset. So that means the full unfettered ability to use the asset, sell it how you see fit. In some crypto projects, given the way that they're distributed, without getting in the weeds, there's some limitations to where even though you receive a portion of the crypto income, you don't really have control over it till you take a second step. One example is there's a node project I'm involved in where it's on Ethereum. Ethereum transaction fees are bonkers high. So instead of depositing your rewards for running a node, which is similar to mining, instead you're getting these node rewards every day. Instead of getting it actually minted to the blockchain, you're getting a voucher that would allow you to mint those tokens to the blockchain later. So in those examples, and again, it's hard to talk about without getting too much in the weeds, in those examples, it's not taxable income until you actually mint the token to the blockchain. So in those instances, when we're talking about 2021, everyone is avoiding minting at all costs because that's generating a taxable event, and why would I want that? Well, now with the market so in the toilet, we're kind of doing the opposite. For a lot of clients who have those nodes, we're telling them to go ahead and mint the tokens now, because the income you're realizing is based on what the fair market value of the token is as of the date you mint it. So last year, one project I'm in, the token was worth 50 cents. Now it's worth 5 cents. I'm a lot happier minting those now, taking the tax hit, but then not only is it reducing that tax hit on the minting, but that also starts your holding period for capital gains purposes. So one example we gave was for this project, let's say you had 1 million tokens, and there's two different guys. They both have 1 million tokens that they've mined. One guy mints his at 5 cents, and then he sells it a year later for 60 cents. The other guy mints his at 50 cents, and then sells it at 60 cents. So both of them have the same sale price. They both have $600,000 of token income. But the one guy, because so much of it, but it's splitting it's different buckets that they're allocated in. One guy has $50,000 of node income and $550,000 of capital gains. The other guy has $500,000 of node income and $100,000 of capital gains. And all of his capital gains are short term. So when you run through the numbers in that, again, this is a hypothetical, but the dude who minted his earlier and then has more of it in capital gains versus node income, he pays half of what the other guy pays in tax.
Yeah.
The one guy was paying, $215,000 and the other guy was paying $115,000.
Right.
So that example, it's always like, I really like that example in some ways because it really illustrates the control aspect, but it is also specific to this kind of specific subset of projects.
Yeah, right.
Which is one of the reasons why we really tell clients you want to work with a CPA, tax attorney, whatever the professional is, who's an actual crypto user. Because if you're doing a continuing ed course and you just hear someone talk about crypto and you get the cliff notes, that will get you part of the way there. But these little nuances and the mechanics of how these projects work can be so important to things like that project I was just describing. If you're doing it from a super academic approach and you're not a crypto user, it's really easy to miss out on those nuances.
Yeah. That can really have a dramatic impact. And so breaking down your example and take it maybe a step or two slower, there's a difference in the way we're taxed when it comes to income versus capital gains. And so when the example we were using earlier is maybe you put $10,000 into a crypto wallet, you buy a coin. If it goes up in value, you have a capital gain on your hands, right? Well, there's a difference between short-term and long-term capital gains. Anything that you hold and then sell within 365 days is taxed as a short-term capital gain at the same rate as your income. But once you hold on to this asset that's being taxed as a capital gain for 366 days, bingo, long-term capital gains taxes apply. So if you're a high-income person who's in the 37% bracket, those short-term capital gains would be taxed at 37% plus whatever your state liability is going to be. But as soon as you hold it for a year, there are only 3 long-term capital gains tax brackets, avoiding the net investment income tax, ignoring that, right? It's 0%, 15%, and 20%. And so if you're paying 37% on a short-term capital gain, presumably you're paying 20% on a long-term capital gain. So we want to hold these things for at least a year when you have discretion because the gain is going to be taxed at a lower rate. And so what I hear you saying in this example is in a lot of these crypto projects, you have discretion over when receipt is actually triggered. And when that happens, the receipt is taxed as income. And from that point forward, the value there afterwards, so if you receive it in your example and it's worth 5 cents at the time, you're going to pay tax on 5 cents per coin or per whatever the unit is. Any appreciation on top of that is a capital gain. And so the earlier that you do it, this being a down year, the earlier that you trigger the receipt and trigger the income, the more time you have to count toward the long-term capital gains treatment, which we like. And if things rebound, that's going to be beneficial because a larger portion of the value will be taxed as a capital gain versus income anyway. Right?
You broke that down perfectly. That's a perfect summary.
Good. I like to check this with professionals like you every now and then. I'm pretty sure I know what I'm talking about, but I am not a CPA.
Oh yeah, no, that was perfect. Yeah, that was great.
So much of tax and what we do here in the financial planning practice, we do a lot of tax planning for people before and after retirement. For business owners, you often have a lot of fluctuating income, and after doing this for a long time, so much of tax planning really comes down to using our progressive system to your advantage. The more income that we have, the higher rate of tax that we pay. So if you're in a down income year because of business or crypto, winter, or any of it, well, now's a pretty good time to trigger income and fill up those lower brackets while you can. When you're in your high income years, defer, right?
Right, exactly.
I mean, it just seems to me that so much of it comes down to the usage of those progressive marginal brackets.
Mm-hmm. Oh, I mean, that's a massive part of it. And a lot of times when clients will first start working with us, and this isn't the wrong, a lot of times this still ends up being the right strategy, but they're like, all right, how do we get my tax bill down this year? How do I get it down this year? And we have to say, okay, I'm with you on that. Obviously, we want to reduce your taxes, but we're looking at this with a 5-10 year horizon, not just what helps us this year. Because a lot of times what will end up saving you the most in the long run is you want to avoid those big peaks and valleys like you're talking about. So we're trying to do everything we can to kind of level out that income, because if we do that, then you're usually paying it at a much lower average tax rate.
Yeah. That's well put. So what about NFTs in this ecosystem?
Yeah.
How are those bad boys taxed?
NFTs are, and I love NFTs. NFTs are an absolute nightmare right now. And the main reason goes back to a lot of the issues we have with most things crypto, is that there's no NFT specific guidance. The IRS has not addressed it whatsoever. The other thing that's interesting with NFTs is that our theory, at least, is that there's going to be the use case of each NFT is going to become a big point of contention and is going to cause a lot of litigation over the next decade or two. Because for right now, for intangible assets, usually the only real intangible assets have mostly been like trademark, copyright, things like that. So for most cases, that it's kind of a limited bucket that intangible assets are put into, and NFTs are intangible assets. So for intangible assets, there's usually two main buckets that they'll fall into for tax purposes. One is that it's a non-amortizing intangible asset. You just put it on your balance sheet. You don't get to expense it over time by amortization. The other one would be that it is an amortizing intangible, and you usually do that under what they call Section 197 of the IRS code. And Section 197 intangibles amortize, which means expensing them over time. It's the lesser of 15 years or the useful life of the asset. So the example we'll give is that for most people, when they're talking about NFTs, they're still thinking about sort of, for lack of a better term, the profile picture NFTs, the CryptoPunks, the Bored Apes, the ones that are just collectible art, and that's about all they really provide. So for those are most analogous to collectibles, because you're doing it, they don't really provide utility. It's only for the rarity and sort of newness of it that you're investing in them. So collectibles are taxed instead of regular long-term capital gains. Collectibles are taxed at a rate, if they're of either the lesser of your ordinary income tax rate or 28%. They don't get that more favorable capital gains treatment. So for a lot of these NFTs, that's the way they need to be taxed. But NFTs the use case for NFTs is so expansive, or at least could be really expansive, that I think that there's going to be a lot of debate and litigation surrounding it. The example we'll give is that play to earn gaming, which is these are video games that are played on the blockchain, and for playing them, they'll actually reward you with cryptocurrency tokens. So you actually earn a little bit of money for playing these video games. And play to earn games, a lot of the items in the games are NFTs. They're these non-fungible tokens. So the example we'll give is, let's say that you're playing a World of Warcraft ripoff type game. You're playing one of these massively multiplayer online role-playing games. And in the game, you buy a sword that the sword doesn't degrade over time, but it increasingly becomes more obsolete because newer versions come out all the time. You've got a hatchet or a pickaxe that you're using the pickaxe to mine, but it degrades really quickly and you've got to replace it. And you buy a plot of land that you can use in the game. You buy a building in the game that you rent out to someone so they can run a tavern. And I think we also listed, like, you've got a piece of art within the game that you can hang in your digital house. Well, all of those things, if they were real world assets, would be taxed very, very differently. The land would only go up in value in most cases. You wouldn't depreciate it. The building depreciates over 30 years, 30 or 40 years, and should go up in value. Same with the collectible. But then you've got the sword and the pickaxe and those other items that have a much shorter useful life. So there's NFTs out there that all they do is they grant you membership to mastermind groups or Discord servers. They're sort of the way you're paying for your dues and subscriptions is by buying the NFT. So with that, such a broad array of use cases for NFTs, I think when the IRS does finally issue guidance, it's going to be really, really narrow, and it's going to be more tailored to those profile picture NFTs. And there's going to be all kinds of people who are saying, like, yeah, I get it's an NFT, but look at the use case. Look at the way that I'm actually using this, and are going to say, I think I should be able to expense this or amortize this over 1 year, 2 years, 3 years, something way less than the IRS is probably going to want them to do.
Right. Interesting. Can we rewind to this concept of the video game example that you gave? Why? And this is a new concept to me. Is play to earn. With the basic form of blockchain, like Bitcoin being a good example, you participate in the proof of work. You trade computing energy in exchange for a mining reward, and it's a self-sustaining system. I understand that pretty well. Why is in this video game setting, when players play the game in exchange for reward, why is the video game producing a reward? What's in it for the game or the producer of the game?
Well, it's funny you say that, because right now, even though I really like the concept of these play to earn games, they're having struggle keeping their economies afloat, because there are all kinds of games out there who have most of these online role-playing games, they have their own in-game economies. Like World of Warcraft and RuneScape, those games have been around like 20 years now at this point, and they have had ongoing economies that pay you gold, and that gold there's companies that you can go and buy, people who have been what they call gold farmers, who do really mundane tasks in the game all day long. They'll sell you the gold for this bargain bin price. So it already sort of exists within online games that you've got these self-sustaining in-game economies. So what they're doing with these games is the same general concept, except you're getting, except the tokens and the NFT, the in-game items that you're getting are actually minted on the actual blockchain. So it's a concept that's partially been a similar thing has already been proven to be sustainable. But the problem ends up being, at least so far, is that the way they need to look at these video games is that they're video games that just happen to pay you a little bit of cryptocurrency. The way that they're being viewed are more as investment vehicles, and then the gaming is secondary. So what we've seen with almost all of these games so far is that the early players buy an NFT for $5, and the game starts getting more and more popular. And all of a sudden, as the game spikes, their NFT value goes up wildly, and they're earning $200 a day just for playing this game. So then people say, great, I'm making all this money. I'm going to reinvest all these earnings back into the video game because it's making me all this money. And more people get on the bandwagon. And then ultimately, either there's not enough what they call money sucks in the game and the token becomes super inflationary, or people just say, hey, I'm going to cash out. And then the token price crashes, and so do the value of the in-game NFTs. And in most cases, the token price goes down like 99% from where it was at its peak.
Yeah.
So right now, the problem ends up being with these play-to-earn games is people look at it as they look at it the same as they do an investment vehicle, and they want to get a superior rate of return than they would versus if they bought Bitcoin or Ethereum or were mining. And I think they're real, including myself for a while, we're missing the point. The point is to make a fun video game where it just so happens that you can earn a little bit of money for doing it. Instead of just it being a pure cash suck, you can get some or all of your money, or maybe make a little bit of profit. But right now, because there's so much of a greed aspect in it, and in looking at it as an investment first, they end up being pretty horrible investments so far, at least.
Yeah, interesting.
But I do think it's, if they can fix the mindset, there's a lot to be said for it, because back when I was younger, when I was a kid and a teenager, I played games all the time. And if there had been a game out there that I could have earned $1 a day for playing, if the game was as fun as other games and I could earn a tiny bit of money for doing it, that absolutely would have been the game I'm playing. So that's the way I think that, at least my opinion, they need to reframe things. Because right now it's like you're competing against your in-game earnings needing to be superior to running your own mining operation or node or deploying it into an actual investment.
Sure. Interesting. It'd be a tall task. I mean, anytime you mix those kind of market structures with your product, the game, there are going to be people out there that are going to try to exploit that for money. And
absolutely.
I don't know what you do if you're running one of those things. So here's another question for you, Micah, and this one is front of mind and something that I've been wanting to ask you all week as I got ready for our interview. So we had a client come in last year, and they're involved in a bunch of crypto stuff, and then it comes tax time. And you know, when you have investments in a brokerage account, you buy and sell throughout the year, and then they issue you a 1099 that reports on all those transactions. So it's pretty easy, right? You get it electronically, you hand it over to your tax preparer, or you upload it directly to TurboTax. They just produce the return for you, and it's done. With crypto, not the case, right? Are there any outfits that are giving you a 1099? How on earth are you tracking this stuff? Our client had to buy this fancy software to
you have
go back
to
and track all this activity.
It's an absolute nightmare. If let's say you just have your sort of a beginner to intermediate, or you just have a simple investment strategy and you're doing everything on Coinbase or one exchange. Coinbase is required to report, these centralized exchanges are required to report some of these things to the IRS now. So if all you did was trade on one exchange, they'll give you a report that will be reasonably accurate that you can use for the tax return. But at the point when you've got it in multiple wallets, especially if you're using one of these things on a decentralized exchange that's not tied to an actual company, you've got to buy a coin tracking software. Otherwise, because what they'll do, the trades are similar to stocks, but it's just you don't get the benefit of your broker sending you the statement. When you're executing the trades, it's based on whatever the token value is at that time, not only the token you're buying or you're selling, but a lot of times you're trading it for another token. So you need to know the value of the token you're buying. And also there's going to be exchange fees or gas fees. And if you're trying to do that on your own, it's not impossible, but it's so likely that you're going to miss things. So for most people, we tell them you're going to need to use Coinly, CoinTracker, cointracking.info, one of these programs that is designed to pull all that information from all of your various wallets or crypto accounts. And even then, and we tell people don't do it on your own, you'll miss everything. Even then, it still feels like those programs are in beta testing a little bit. We still end up having to go through and redline them for the things that get missed. So again, it's one of those things that we hope as the industry matures a little bit more, it will get better. But it's no fun right now. It's a real cluster because you've got to pay for, sometimes, especially if you're a high volume trader, a lot of those programs end up being pretty expensive. You've got to go through and do all of the data entry and telling it what the transactions are. And even then it ends up being mostly right.
Yeah, right. So how far off are we, do you think, from these exchanges having a requirement to report 1099s and do this on your behalf?
A little ways away. I could be pleasantly surprised, but at least right now, the IRS has already forced them to report, sort of like when you used to have basis not covered, or like you had non-covered securities.
Right
now, the IRS is more and more forcing them to report the income that you have. Like if you have if you've got your stuff there staking on a centralized exchange, or you've got deposits where you're receiving interest for holding it on those exchanges, they'll issue you a 1099 INT or a 1099 miscellaneous. And then they're also reporting a lot of your sales and proceeds to the IRS, but they're not necessarily doing anything in terms of reporting the basis to them. So I think what we're going to see we're going to see more and more of them trying to ratchet these exchanges or brokers or sort of the people who are acting as the intermediaries to where this money is being exchanged. They're going to be forcing them more and more to report the income. I think the cost basis and cost tracking, that at least my guess is that that's going to be secondary to them getting all the income easily reported to them.
Right, right. So what do you suggest people do that are actively involved in this? If you have to get the software, but then it takes work reconciling all the transactions. It's not even right 100% of the time. What do you suggest people do that are interested in this for tax reporting purposes?
The biggest thing is, and this is true of a regular business, is do it in real time, because especially if you've got an all complicated portfolio where you're actively trading or you're transferring a lot between wallets, or you've got tokens that are giving you airdrops, the more expansive your activity becomes. If you're keeping up with it and reconciling your accounts every couple weeks to a month, you at least kind of remember what you did. But if you're trying to do it a year later and you're executing several hundred transactions a month, that's going to be really, really tough. And there's more likelihood that you're going to categorize it incorrectly because you didn't remember what was going on when you executed that trade. So it sounds basic, but it's really, right now we've got a fair number of people who are on extension for 2021 because they haven't gotten around to, they waited, and then when they finally got the program, they have 5,000 transactions they need to deal with. So if you can kind of do it in little small bites, it'll be a lot easier for you to keep up with it. And also that allows you for tax planning purposes. When the main thing we're doing, we do the tax return, but the main thing we're doing is planning with our clients throughout the year. And we need that data to be able to plan properly. So
Right.
All around, you're just going to be in a much better position if you're doing it in real time.
Right. What is your risk if you do it wrong? If you have all these transactions and you're off, in a legitimate way, you just get it wrong. Are you at substantial audit risk?
I mean, it depends on exactly how and where you were wrong, because it's expanding all the time what the IRS is getting reported to it. So if you're doing everything on Coinbase, and the IRS is going to send you a nastygram because they're going to know that you did all this trading and you forgot to disclose it, or it doesn't match up with their numbers. But if you're doing everything through MetaMask and you're doing it on decentralized exchanges, then they're not going to automatically send you a letter. But if they do audit you, the recreation process ends up being so much more difficult because you don't have anything from the exchange to help you out. So we tell everyone, just do the best you can, make sure you're reporting all of your income, that you're being honest with it. But so long as you can show that you're making a real honest effort to report it and did the best you could, then the likelihood of all that's really going to happen, the vast majority of cases, is going to be what the IRS does whenever they audit you. They're going to disallow the deduction, or increase the in taxable income, however you want to state it. They're going to make their adjustment. You're going to need to pay the tax that you would have paid originally, and then they'll usually do a surcharge, a penalty of about 25% on top of that. So it's not ideal, obviously. We'd much rather avoid that completely. But so long as it's not wanton and blatant fraud, it's clear that you're just trying to defraud the US government, usually they're going to see that and be reasonable and try to work with you.
Yeah. Okay. Does reporting cryptocurrency transactions at all, or having Coinbase or wherever else report on your behalf, does being involved in this put you at greater risk of audit in the first place?
Not that we've seen so far. That could obviously change. The IRS doesn't disclose what their hot button issues are and what will trigger it. For all the clients we have in crypto, we haven't found that to be the case yet. That could obviously change, especially with all of the new agents that are coming in.
Yeah.
That will be and we don't know what they're going to be working on.
Yeah, interesting. Okay. Very cool. So this is a show that's meant to help business owners align their personal finances and intentions with their career and their lives with their business operations. And I think a lot of businesses out there, maybe not so much this year, but in previous years have been tempted, if not have just considered taking cryptocurrency as payment in various forms. What does that look like operationally? If you're a business owner considering taking crypto as payment, what are you getting yourself into, and how big of a job is that?
We accept crypto as payment. So if you've got a market that wants to do that, then absolutely, I think it's a good avenue to go through. The thing that you're going to want to do is that either have an option to receive payment in a stable coin, which stable coins are tokens that just stay at $1.
Theoretically.
Or right, theoretically. There've been a handful. That's another thing we've talked a lot about in our tax planning, is telling people the money as you're executing trades and getting income, make sure you're setting aside the money for your taxes and don't keep it in stable coins. Or if you do keep it in stable coins, understand the risk, because either the token could fail, like we saw with UST and Terra Luna, or maybe you've got a real stable coin like USDC, but you held it on Celsius or Voyager, one of these exchanges that have gone bankrupt. Mm-hmm. In both cases, you're absolutely hosed, because it's not FDIC insured cash.
Right.
What was the question before? I got off on that tangent.
So if you're a business owner considering crypto as payment, what are you getting yourself into?
So either stable coins are one option. The other thing is that if you're receiving it in Bitcoin, Ethereum, whatever, if you're going to need that money for your actual operations and you're planning on spending that money, you really want to convert it to cash almost immediately. The reason being is that otherwise you're already going to have a capital gain or capital loss. But if you execute it immediately, it's really easy to track, and you don't have to deal with holding periods or anything like that. But if you're already buying Bitcoin and you don't want to sell it, cool, just park it in an account, just leave it alone. But if it's going to be spent at all quickly, you're much better off just going ahead and converting it, because otherwise you've got the capital gains and capital losses to deal with on your return. But as we've seen with the market going down, it's a crapshoot what it's going to actually be worth. Yeah. You could be doing an appointment at $300 an hour, and you received the payment in Bitcoin, and then a month later you effectively got $150 because Bitcoin has crashed and you didn't exchange it. So that's one of the big things that we'll tell. It's pretty simple, but that's one of the big things. If you don't want to deal with this huge portfolio, you don't want a big portfolio balance variance on funds that you're going to need within a month.
Right.
It's not great for cash flow.
Yeah, right. Are point of sales systems these days capable of accepting a variety of cryptocurrencies and then tracking those transactions? Or are you getting yourself in a situation where you need to set the tracking software up for your business to record the capital gains and losses as well?
I'm not sure if any of them automatically do it. I imagine that's in the works, but I haven't heard. There could be one that exists. I haven't seen it yet. Mm-hmm. What we're seeing more of versus people paying with actual from their crypto wallet to another wallet is we're seeing more and more cards that are coming out that allow you. It's just a Visa or MasterCard, mm-hmm. but they're funded with your crypto. They're crypto debit cards, and then there's a handful of crypto credit cards as well. So that's what I think will probably, which is kind of funny because to an extent, it's like that's what we were trying to get away from traditional payment processors. Yep. But I think that's a big part of where crypto will actually end up being spent here in this next sort of couple years, will be people just loading it onto their cards, and like you do with a prepaid debit card.
Right. So taking a step back at a higher level here, I think there's this, especially this year after the crypto market has, a lot of it has been cut in half or more, lost 50% or more of value kind of across the board. There's this ongoing debate about whether this is here to stay and what, the price of Bitcoin and Ethereum might be 10 years down the road. It seems to me that it's clearly an innovative new technology and more efficient way to manage a financial system. But it also seems to me that most of the coins that exist out there now are totally worthless and are going to be going to zero at some point. Where do you stand on all this? I mean, you talk to a lot of people. Your business is revolved around this, and you're engaged in it yourself. What are your thoughts on where this is going?
Yeah, I think what we're going to see, and again, it's something that the true crypto zealots are not going to be super happy with, because the whole idea is decentralization and not having it in these big, I'm saying it's the same, these big centralized institutions, the way that we do with major corporations now. But I think what's going to happen as regulation is getting ramped up all the time, and the reporting requirements for companies involved in blockchain are going to get more and more and more. I think what we're going to see is that we're going to see a real consolidation in the space, and we already are to some extent. But so when I'm investing, unless it's just for kicks and giggles, and I throw $25 into the equivalent of a penny stock in crypto, I think these small projects, even if they come up with something really innovative, given how expensive it is to develop the technology, and given the massive amount of money that is behind these major, top 100, 200, one of these big companies, because some of these are billion-dollar companies, given how much money they have to comply with regulation, to drive regulation to be where it wants to go, and also duplicate what tiny indie companies are doing, I would look at smaller companies almost like you're like a lottery ticket scratcher or something. You might get really lucky, but the risk on those is exponentially higher than if you're investing in one of these major projects.
Yeah.
So that's where we invest in bigger projects. And there was a period when I was first getting into crypto where it was super fun to go on, spend $100 on these little projects, but all of them, I'd say most of them are down 90%. So it's fine because it was just a little bit of play money on them, but it is such an uphill battle for them to be long-term investments. The people who do well with those altcoins generally are experienced traders and know, they get 20% of upside, whatever they're looking for, and they just play the fluctuations. If you're just a buy and hold investor, again, you might get really lucky, but most of those, they'll spike up, then they'll go down for a long time. It's harder to make money versus if you're buying Bitcoin and you just leave it alone. The assumption is that over time it will eventually be worth a lot more. These small projects are really risky long term.
Do you feel like those mainstream coins will be worth far more than they are today down the road?
I think some of them, on balance they will be, but it's the whole ecosystem got really shook up when Terra Luna collapsed, because that was their stablecoin UST was, I think, a top 10 or it was in terms of market cap, it was number 10 or 11. And the associated coin Terra Luna was whatever, it was right next to it. It was 10 or 11 as well. So I think those wiped out a combined like $60 billion or something, just incredible, in like 3 days. So if you're talking about Bitcoin, Ethereum, Cardano, these big projects, if you're investing in a bunch of top 100 projects, on the whole, I think you're going to do just fine over time. But I definitely wouldn't put all your eggs in one basket, because that illustrates how even a major project can go bankrupt basically overnight.
Yeah.
So that's one of the things that we do in our investing, and not that we're investment advisors, but one of the things we urge people not to do is become too concentrated in one project, even if they love it, because we really need to not forget how astoundingly volatile crypto still is.
Right, right. Yeah, my thought on this is that I agree with you. I think the major ones are going to be around, but I'm not convinced that Bitcoin's going to like $300,000 or
Yeah.
$500,000 a share, because you, every time there has been a threat to the world's reserve currencies, there's been a very profound reaction from the controller of that currency. For example, we have the world's reserve currency here in the U.S., the U.S. dollar, and we have the ability to control the printing press, which we're very good at exercising here in this
Right.
country. And a topic for another day. But I think all the major countries that hold all the major currencies around the world are going to come up with their own um, form of digital currency that utilizes the benefits of a blockchain or something similar. And China's halfway there already. I know we're exploring it. And I think that that's going to really impact the market for just the entire crypto world. On top of the fact that money has been really, really easy for a long time. And anytime you
Hmm.
have these prolonged periods of easy money, these bubbles start to pop up all over the place, and there's just general froth in the markets. And I can't think of a better example of market froth as a result of easy money than a Bored Ape picture where people are paying tens and
Hmm.
hundreds of thousands of dollars for a digital image. I just can't wrap my head around why that makes sense.
Oh, it's well, and so far everyone who's done it has done it okay with those big ones. But I agree with you completely, because I think what we've run into is, and why this potentially upcoming recession is going to be really interesting, is that for the past 10 or so years, if you invest in basically anything, you're going to make money.
Mm-hmm.
You throw it in the stock market, real estate, you invest in business, you invest in crypto, you're making money. And because of, like you said, how easy the money has been, and how just this bull run that we've been on, people, you run out of things to invest in. It's kind of like how we ended up with all these issues with CDOs and the synthetic swaps back in before 2008, is that there were only so many houses to buy, so people had to find some other ways to park their money and get a return. And I think that's what happened, especially with NFTs, because you ran out of crypto projects you wanted to invest in, so then you had to come up with somewhere else to park your money. So even though they might be fine in the long run, or the general market will be fine. Whether or not each individual project is going to be fine is where you can really get hosed. Um, as things start to slow down, these speculative investments are the first thing to go. And
Yeah.
so I think that's what we saw when things got shaken up recently. And if things get worse, we could very much see it's harder to justify that this JPEG that you have is worth $500,000 when you're going through some huge global recession.
Mm-hmm. That was well put. In the aftermath of after the tech bubble popped, a lot of people that got wiped out are saying, "Holy smokes! Why did I ever think that company that was unprofitable over its
Yeah.
entire existence was going to continue?" It's so obvious to me. And I just think of
Mm-hmm.
this as another example. You're paying tens and hundreds of thousands of dollars for a digital image that the value of all this entire industry and market could get wiped out tomorrow. It just seems ripe for reckoning from my
Mm-hmm.
perspective. But it's a new
Oh
world.
yeah.
I could be wrong. I don't
Well,
know.
well,
you know.
again, I think there's going to be, especially for NFTs, I think there's going to be, and even the major crypto projects, like you said, countries might come out with their own blockchain and their own currencies that operate on the blockchain. The projects that provide a non a lot of these projects aren't the Bitcoin. The idea of a digital currency in the form of especially Bitcoin, it's too slow. It doesn't work. It has other reasons why it can be a store of value, but I think the ones that are going to do well are the ones who are using blockchain as a utility for like Web3 for data processing. I think the ones that are going to do really well are these utility coins and utility NFTs even.
Mm-hmm.
Um, that that are providing it's the next era of tech innovation versus trying to be a a currency and payment processing.
Yeah.
But it's going to be interesting. It's a whole new world. So.
That it will be very interesting. Well, Micah, let's wrap this up. Thank you for coming on. I really enjoyed this conversation. You're kind of at the bleeding edge of understanding the tax ramifications of this stuff, and you're doing excellent work. Where can people find you if they're in a situation where they need a tax person that is focused on this?
Yeah, so they can go to our website. It's cryptotaxcpa.com. And if they're looking for guidance, just general guidance on some of these principles, we've also got a book on Amazon called Decrypting Crypto Taxes. And then the subtitle is The Complete Guide to Cryptocurrency and NFT Taxation. The digital version of that is free on Amazon right now. So that's another resource they can look at for the topics we discussed and a bunch of ones that we obviously didn't have time to discuss.
Very cool. Well, we'll link to those resources in the show notes. And this has been great. Thank you again for awesome. Your time. Look forward to continuing the conversation.
All right. Thanks, man. Really appreciate you having me.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.